Well, little WolfStreet.com. The Fed explains why it's doing all the rate hikes to prevent financial crisis 2.0, apparently. Instead of bubble or collapse, it uses valuation pressures and broad adjustment in prices. Business debt, they say not consumer debt, is the boogeyman this time, preventing another financial crisis or promoting financial stability, as the Federal Reserve Board of Governors calls it, isn't the new third mandate of the Fed, but a key element in meeting its dual mandate of full employment and price stability, according to the Fed's first financial stability report. As we saw in 2007 to 2009 financial crisis, in an unstable financial system, adverse events are more likely to result in several financial stress, not several, but severe financial stress, and disrupt the flow of credit, leading to high unemployment and great financial hardship. Financial firms are okay-ish, except for hedge funds. Let's scroll down to that piece. The largest banks are strongly capitalized and are better able to withstand shocks than they were before the financial crisis, and credit quality of bank loans appears strong, although there are some signs of more aggressive risk-taking by the banks, the Financial Stability Report says. Also, leverage at broker-dealers is substantially below pre-crisis levels, and insurance companies have also strengthened their financial position since the crisis. I mean, do I really believe that that's the case? I'll be honest with you. No. No. A greater worry are hedge funds that are now being leveraged up to the hilt. A comprehensive measure that incorporates margin loans, repurchase agreements or repos, and derivatives, but is only available with a significant time lag, suggests that average hedge fund leverage has risen by about 1/3 over the course of 2016 and 2017. The increased use of leverage by hedge funds exposes their counterparties to risks that would include banks and broker-dealers, and raises the possibility that adverse shocks would result in forced asset sales by hedge funds that could exacerbate price declines. But here is why they won't get bailed out. That said, hedge funds do not play the same central role in the financial system as banks and other institutions. Consumers are in pretty good shape, except in terms of their mortgage debt to GDP and income levels, consumers are in pretty good shape, the report said. But student loans, 90% of which are guaranteed by the government, of course, and remember, those are considered assets. At the government's books, those loans are assets. Hilarious. 90% of which are guaranteed by the government, and auto loans are out of whack, and there are some problems in the subprime segment. There we go. But business debt, oh my, they say. The feds find that asset valuations are generally elevated as investors exhibit a high tolerance for risk-taking, particularly with respect to assets linked to business debt. Asset valuations appear high relative to their historical ranges in several major markets, suggesting that investor appetite for risk is elevated. In this category of overvalued assets waiting for sharp price declines, it lists commercial real estate, $21.2 trillion in assets. It has a lot to say about CRE valuations and risks. See below. Junk bonds and leverage loans, $2.4 trillion combined, dollars that is, exhibit yield spreads to treasury securities that are near the lower end of their historic range. Investment grade corporate bonds and commercial paper, $6.2 trillion. Stocks, $33.8 trillion in market capitalization, have seen rise in price to earnings ratios since 2012 that are now above their median values over the past 30 years, despite recent price declines. And then farmland prices, $2.2 trillion total, though down from the 2016 peak, remain relatively high by historical standards. So commercial real estate, which is again $21.2 trillion in assets, though prices of commercial real estate have been about flat compared to a year ago, they had been growing faster than rents for years. The chart below shows the index of CRE prices adjusted for inflation via core CPI. The real CRE prices are now higher than they were before it all blew up. And he says, I added a special line in red there. I don't need to show you the chart. Bottom line is we are above, at least with commercial real estate, we are above the high from 2006 and 7. And we saw how that ended. So are we peaking? Is there a crest? I mean, it sure seems like it. I've been saying this for months and months now. Is it the next year, 2 year? Again, the guy that I told you guys about that called for $38 Litecoin, and then even in the 20s for Litecoin, had told me, because I'd asked him originally, like, you know, these guys that told you about the price of Litecoin and cryptos and all that, or in Bitcoin, you know, how's their track record? And he said, well, they only told me one thing about cryptos last year, and that would be around 15 or 16K for Bitcoin, and that would be about it. And so I'm like, okay, so they don't really have a running track record that I could really come back and say, hey guys, this guy's guy said such and such, and he's got, you know, the last 5 things right. I couldn't say that. Unfortunately, it didn't seem to matter because he appeared to be right. But when I asked him that, he said, you know, on other things, these guys have been spot on. And I said, okay, you know, like what? He said, well, he's like, for example, housing. When the last housing crash happened, they told me to get the hell out of my house, get rid of it, sell it, go rent for a while, and then get ready to buy a house cheaper. And I think he said he did. And, you know, you saw what happened to housing prices in 2011 and 12. You know, after it already started crashing after 06 and 7. That was like the bottom, was like 2010, 11. And point of me telling you this right now is because he said housing 2.0, they've given him their opinion that it's right around the corner. And they said maybe a couple years to maybe like worst case scenario, longest case out would be like 3 years. So basically 2 years. I'd put this right around 2020. But if you look, again, if you look back at 2006 and 7, it wasn't like that happened and then everything crashed the next year and then it started going back up. It was 08, got a little worse, 09, worse, 2010, worse. And again, I want to say around 2011 was like the bottom. And then we started rising up. So I could honestly see something like that happening, where we start to see cracks in the system, which is why I'm doing all these videos. I've been telling you all about this for a while. Leads to lower prices. Okay, we've peaked over here, we've peaked over there. Time to see some issues, you know, are rising that push the price down. We're already seeing some. I mean, I was just scanning, you know, some zero hedge stuff, and they were talking about, once again, I think some part of California, I don't know if it was San Francisco or whatever. Back in the news, housing prices dropping again over there. I mean, it's out of control over there. But anyways, these high prices have led to capitalization rates at the time of purchase that are compared to 10-year Treasury securities very low. In other words, returns to CRE property investors thus reflect a relatively low premium over very safe alternative investments. And of course, this cannot last. The chart below shows the 3 months moving average of cap rates across the U.S. on a square footage basis for industrial warehouses and things like that, retail, office, and multifamily sectors. And as far as capitalization rate goes, it's not, again, not looking too, as they'd say on the Smurfs, it is not looking too Smurfalicious. Okay, it's not looking very Smurfy. Given the CRE bubble of historic proportions, banks could or should tighten lending to curtail their risks. Instead, they have eased a bit over the past year. Borrowing by non-financial businesses, $17.1 trillion, excluding banks. Business sector debt relative to GDP is historically high, and there are signs of deteriorating credit standards, the report warns, with debt growing fastest at firms with weaker earnings and higher leverage. Again, it's no different than you and I. Oh, you need a car? You need a new car? See, now we're talking about companies. And companies get bigger loans than you and I get because they need them. You know, they need more. It's a company. It's not just an individual or a family. It is a freaking company. They need a big loan. You and I, oh, get a car loan. Need a new car. It's been 5 years, man. Need a new car. How much can you afford? I can afford $300 a month. Got any 5-year loans? Oh, we don't have anything on the lot with 5-year loan for $300 a month. What? What do you got? Well, I could put you in a 7-year for this jabroni car over here. I could put you in a 7-year on the jabroni car to meet you $300 a month. You want to step up a little bit, the one you've been looking at, well, I could probably put you in a 9, maybe a 10-year loan on that. Hold on. You're going to get a loan on a car for 9 and 10 years? 8, 9, 10 years? Yeah, I've been talking about this for a while. This is so mind-boggling that this is even allowed. Like, just like our mortgages, you used to have a 10-year mortgage, put 50% down, you paid off some for 5, 10 years. Depression happens, we don't want everyone to lose their house, so we're just gonna lower your mortgage rates massively. Instead of 10 years, we're gonna let you stay in your house and we're gonna extend it for 30 years. You know, because the government, we love you. Oh, okay, thanks. So when things recover, we'll go back to the 10-year, right? Oh, of course, of course. And a strange thing happened. Prices still skyrocketed, housing-wise. Again, looking back that far, the Great Depression. And we still got 30-year loans. Still got them. When you go to look at a house these days, what can I afford? Oh, well, that's not the greatest neighborhood. Let's look around. Okay, we're about the top of our budget there, but at least we're in a nicer neighborhood. I like that house. Okay, honey. When that whole conversation's happening, you are in a 30-year mortgage. There's no such thing as, well, we're looking at a 20-year mortgage and this is what we can afford. Or a 15-year mortgage. Your rate will be a little lower. Yeah, I know. But your payment's still going to be a lot higher because it's a 15-year mortgage, not a 30. You can no longer afford that house. You can no longer afford that beautiful house you want, 15 years. Now you got to get a 30-year. So what this is saying, business sector debt relative to GDP is historically high, and there are signs of deteriorating credit standards. The report warns with debt growing fastest at firms with weaker earnings and higher leverage. That's like saying there's more loans going out to people who don't have jobs and can't afford to pay it back. Well, how do you think that's going to... Oh, it'll probably be okay. It'll be okay. It'll be, ooh, child, things are going to get easier. No, I don't think so, actually. Again, these are all the telltale signs. This is why I'm just trying to do a lot of different stuff. CBD oil sales. See the description box below. CBD oil. I bought some more crypto recently. Told you, I got some more Litecoin. And FYI, I got out of my Ethereum Classic that I did have a little bit of, and just went ahead and put that into Litecoin for the time being. Some more Litecoin. I was reading some news, like the main development team on Ethereum Classic is due to the market conditions and we can't afford to stay alive. We're shutting down. Shut it down, says Chef Ramsay. And I said, that could be fun to scare you out of your Ethereum Classic, and then there's breaking news, they're not going to close down after all. Tricked you. Or it could be real. But again, I love Litecoin. I know the prices right now. I just, you know what I'm saying. I can't pass that up. I just feel like my go-to coin. I had to do it. So, anyways, this is the individual, but in a business sense. You ain't got no money. Your credit sucks. We're gonna give you a loan anyways. Everybody's approved. You can get a house. How much do you make? Well, I make $40,000 a year. You make $40,000 a year? You probably need to make about 60. Just put 60 down on the paper. Aren't you guys going to check? No, we don't check that. Just put down to make 60. Yeah, go ahead, sign right there. Yep, initial. Yeah, okay, great. That's how that went last time. Remember that? Everybody's approved. Just make it up, sign it. We're good. And what happened? They couldn't pay for it. Could not even kind of afford it, and they defaulted. And there was a mass wave of defaults. Remember, they tried to blame it on everybody. You guys get adjustable rate mortgages. You guys got those. You people got the adjustable rate mortgages. No, that's what the banks told us we needed. I thought I was just doing what everyone else is doing. Oh, you're not going to stay in this house for long. The price is just going to keep going up. It'll just keep going up. You'll sell it, get a second house, live in that one, rent the other one, flip it. Yeah, you'll be fine. Okay. House prices crash. Your adjustable rate mortgage, interest rates are going up, and it's really painful. Exactly. Anyways, you get the point. Take care.